If you want to learn one of the most powerful investing techniques that could make you lots and lots of money, then I suggest you watch this video to the end, because I'm going to be covering one of the most powerful strategies. Then I'm going to talk about how you can apply it no matter where we are, whether we're booming or busting or crashing or recessions. And then finally, I'm going to share with you something that no one really talks about, and that is how to put this strategy on steroids. If you watch what I'm about to teach you in this video, it could literally change your life. No BS, no hype. Let's get stuck in. So if you watched my last video, everyone was talking about they wanted a video on advanced dollar cost averaging, and I'm going to give it to you. But before we do that, you have to understand what dollar cost averaging actually is. And you might have heard a quote from Benjamin Graham or Warren Buffett where they say, it's not about timing the market, it's about time in the market. And that quote's banded around and no one really understands what that means. So I'm going to prove to you and show you exactly what that means and what power it can have in your investing. I'm going to show you how you can understand when is the best time to get in. And more importantly, I'm going to show you how to accelerate your profits. So what we're looking at here is a chart of the S&P 500. The S&P 500 are the top 500 performing companies in the world. And what you're looking at is really human innovation, human evolution, if you like. There are real humans behind companies that build great businesses, great products, they go and serve humanity, and the value of those companies grow and grow and grow and grow as a byproduct of providing value to the world. So it's a fund of 500 companies, which means if you put your money into this fund, you're diversified across all different companies and all different sectors. But let me just show you a drawing quickly. I'm going to bring on the iPad here. So let's just say we've got this chart here, and this vertical axis represents price, and let's just say that this horizontal axis represents time. So this is the time and this is the price. And let's just say that you start investing right here, okay? And let's just say, for instance, you put in $1,000 of S&P 500. Let's just say this is the S&P 500. Now you will get whatever of the S&P 500 index fund $1,000 will buy you at that time, right? Now let's just say another month goes by and the price drops of the S&P 500, but you just put in another $1,000 of S&P 500. And what that means is you are getting the average purchase price, which will be between the two of those. Okay. Now let's just say another month goes by and it continues to fall, and you again buy $1,000 worth of S&P 500, and your average purchase price is now here, the median between the two prices. It's important you understand that, because as the market turns and starts to rise again, which it always does because this is human innovation, you'll benefit by exploiting the time diversification, and you will approximate the mean growth of the market and outperform most of the people who try and time the market. Now make sure you do stick around, because I'm going to shatter some misconceptions around timing the market very shortly. So this is what's meant by buying your stocks like groceries and not perfume. Benjamin Graham very famously said that. With perfume, you chop and change. Sometimes there's a delayed period between when you buy and you're picky. And with your groceries, you buy the same thing every single week. That's how you want to be treating your stocks. Now let's look at what the average growth is on this market. Now, one of the S&P 500 funds is called VFinx. It's an index fund, and I've just typed into ChatGPT, what is the average annual performance for the VFinx fund since inception? And the answer is 11.2%. Go over to Forecaster and check out that actual fund. You can see over the last 10 years, it's been 156%. Over the last 20 years, 357%. Okay, let's take a look at another one. This time, let's look at an ETF of the S&P 500 called VOOG. Can you give me the average annual return on VOOG ETF since inception? And this one here is 13.2%. Go over to Forecaster on this one. Let's check the seasonality, and you can see over the last 3 years, 32%. Over the last 5 years, 32%. Over the last 10 years, 24% on a 12-month investment. You can actually see lately the stock does very well. In fact, I'm going to take all this information here and dump it into a spreadsheet. And if you average out those, it's actually 16.24. But we'll go conservative and we'll stick with a 13%. So when you understand this, you don't worry about time in the market. It's all about time in the market. So let's look at this chart. This is a logarithmic chart of the S&P 500, and I'm going to bring on a moving average. So I'm going to bring on a simple moving average. Now this is the monthly time frame. So every one of these candles represents a month of the S&P 500 price. Now let's thicken this up a little bit. Let's make it white. Let's make it nice and thick. And if I just change this length to 1, that means that that moving average is going to represent a very close average of the movement in price. But if we change this to say 12, meaning annual, the average of every year, you're going to see that it starts to smooth out. So when there's a dip, like in the GFC or COVID, as the market starts to recover, you're already in profit way before the full recovery. As soon as price crosses this white line, you're in profit again. Unlike most people who either sell out and lose because they lose their shirt, or those who hold on because their financial advisor told them to and ride it out and wait for the full recovery. And then when they do get back to recovery, they're back to square one, whereas you're in profit. All it means when we dip is you get a better price. There's bargains everywhere. And then when the market's going up, great. The investments that you're already holding are going up in value too. So true passive investors don't care if the market's up, down or sideways, they just keep buying every single month. Now lastly on this bit, let's just say we change this moving average from 12 to 100. You can see it smooths out even further, which means the longer time horizon you have as an investor and the longer that you actually invest in the market, the closer you approximate the true underlying market growth instead of getting swung around like a rookie. And what's more, the more profit you get. Look at the chart. The longer you spend in the market, the more money you make and the less you care about the daily or monthly or even yearly dips, because you're getting in at the average purchase price and the actual price is way up here. Look at that. You're making a killing at this point. Price is high, you're paying the average purchase price and your profit is ginormous. And look at this, the market's way higher now than it was in COVID, and it was way higher in COVID than it was in Trump's trade war in 2018, and in the trade war it was way higher than the GFC, and in the GFC it was higher, and so on and so on and so on. So when there's panic in the streets, you can be greedy when others are fearful, and you can make life-changing profits. Speaking of which, what does it actually mean when you're greedy when others are fearful? What does that actually mean? Well, if you want to step it up a notch, you can increase your regular deposits during the crash by saving and holding some back from your regular deposits when the market is overinflated and overpriced. And then you can save up that cash ready to add even more to your deposits when the market starts tanking, making you even more money. But before I get into that, I just want to prove the point a little more about not trying to time the market. A lot of people, when they start investing, they say, yeah, but I'm too late, or it's not the right time, or I've missed it, or I hear there's going to be a crash soon, so I'll wait for the recovery of that before I get in. Let's take one of the biggest crashes in my lifetime, the GFC. And I'm going to prove to you that if you started investing just before the crash, you would have made more money today, even if you had timed the recovery perfectly and got in without taking that initial loss. And that's because of the magic of dollar cost averaging. So I'm going to get ChatGPT to do some analysis for me. And I've basically said, I want you to give me some data on the S&P 500 index. And I want data from the 1st of July, 2007, which was before the crash, just before the crash, until today's date. And I want you to produce a table, and I want the date, the close price, the number of units we could have bought at each deposit if we were going to deposit $1,000 every single month. I want you to show me the average purchase price and ultimately the profit. All right, so ChatGPT has given me a load of data. I've now put that into Google Sheets. And as you can see up here, we've got pre-crash, okay? So this is the 1st of July, 2007, all the way up to this month. And up the top, we've got the close price of each month. We've got the month number, we've got a deposit which stays consistent across 1,000, and then we've got the amount of units purchased, the total units owned, which is accumulative, and then we've got the average purchase price that we're approximating, and then we've got ultimately the profit. Now, if you look at the chart here, you can see over that period of time, if you just got in and started doing this before the crash, the biggest crash in my investing history, you would have taken a little dip. But look, you would end up today with $247,000. Okay, remember that number, because I've also spat out another alternative here. If we would just time the recovery of that GFC perfectly and got in literally just after. And you can see, if we got in February 2009, when we were recovering right at the bottom, until today, right, until last month or this month, now we look at the profit and you can see it looks similar, but in this case we have $223,000 as opposed to $247,000. That's almost a 25 grand difference. So you would have way more money now, even if you got in just before the crash. So hopefully that makes sense. Now, I mentioned I was going to talk about how to accelerate your wealth in times of a market crash. And when we're crashing, you can make even more money with the strategy I'm about to show you. And here's how it works. So we're dollar cost averaging and the price of the market is going up and up and up. And in times of overinflation, we can start to back off or hold some of our kitty back, our regular deposits back, and save that cash so that we are being fearful when others are greedy. So let's just say that we have another dot-com boom and the market starts to become overpriced, overinflated. If we're tracking the 50-year mean growth of the market, what we can do is we can start to track how far above that mean growth of the market we actually are. And let's just say every month we're dollar cost averaging and we're putting in $1,000 per month, right? Or whatever it is that you're putting in. When we raise more than 10% above the 50-year mean growth of the market, we can start to hold back 25% of our regular deposits. So from that point on, we put, instead of 1,000, we put 750 in. And this is a hypothetical example. And then as the market starts to rise even more and we go 20% above the mean growth of the market, we can then be a little bit more fearful when others are greedy, right? Everyone's greedy. And we can reduce it down to 50%. So at this point, we're putting in $500 per month. And we're saving all of that addition, that would-be deposit, we're saving it in a little kitty. Then what we do is as soon as the market tanks below 10% of that 50-year mean growth of the market, we start putting in our $1,000 a month again, but all of the money that we saved up here and here, we divide evenly across our regular deposits over the next 6 months, say, so that we're getting in cheap, we're getting more for our money, and we've got more money to spend. Make sense? Hopefully it makes sense, because if you understand this, you know how to really accelerate your wealth. Not only are you dollar cost averaging, you're not trying to time the market, you understand the long-term view and the power that has, and you even know how to exploit crashes when there's panic on the streets. You're being greedy when others are fearful. This is what it means to be fearful when others are greedy and greedy when others are fearful. It's one of the most under-talked about strategies, but one of the most powerful strategies, advanced dollar cost averaging. So if you want to learn exactly how I do this personally, then type into the comments investing and I'll send you some cool stuff. And if you want to learn more about this anyway, you can check out my free 7-day wealth training in the description. It's completely free. I'll send you a video a day. And until next time, take care and I'll see you then.